So today we're going to talk about how tax brackets work. If you're like most Americans, then you're likely concerned about being in a higher tax bracket. But many Americans misunderstand how tax brackets work, and they even turn down extra income because of the fear of paying more taxes. We really like this chart by NerdWallet because we think it does a very good job of intuitively explaining how you pay taxes and how tax brackets work. But before we get into it, we do need to explain one concept, and that's taxable income. This chart is talking about taxable income. That's the income to which you're subject to income tax on. So that may be income after deductions and excluding certain sorts of income which are either excluded or not taxable by US tax law. So again, going back to this taxable income, we're going to use the situation of a single person just out of college, poor, and they only have $11,600 in taxable income. So as you can see on the chart, that means they're in the 10% tax bracket, which means from $1 to $11,600, they're just going to pay 10% in income taxes. Just as a side note, there's also payroll taxes and state taxes, but we're not going to get into that. We're just going to focus on federal income tax and a real core concept that we want to make sure that everyone understands. Now, what happens if you get a pay raise in the middle of the year? Instead of 11,600 in taxable income, you end the year in 30,000 in taxable income. Well, no problem. That first 11,600 still subject to 10%. Everything above that is subject to 12%. Now, if you were to get to 50,000, you'd fill up that 0 to 11,600, 10%, 11,601 to 47,150, 12%, and everything else up to the 50,000, 22%. So we see really quickly how that works. I like to use the illustration of different pots and pans on a stove. They have different sizes, and the stove has different temperatures. So you may have a pan on low, one on medium, one on high. Those pans act independently. So they may have the same exact thing in them, but they're going to each be at their own temperature. So similarly, each tax bracket, it's its own entity. It's all money, it's all that stuff in the pan, but it has its own dollar amount of the bracket and it has its own tax rate. So if you earn more or less, it doesn't change that, so to speak. So if you earn into the 24% tax bracket, it doesn't affect anything that's in the pan for the 10, 12, or 22% tax bracket. And so why this is important? Yes, extra income does mean more taxes, but it never means less money. And that's the key concept. Never turn down more income because you're worried about the taxes. But what about tax planning? Well, we don't recommend tax planning for everyone. And generally speaking, it's because the cost benefit analysis isn't there for those who are in the lower tax bracket. However, if you are at or near the 32% tax bracket, you definitely need to be looking at tax planning. If you're self employed, step that amount down. We actually recommend 22%. So, in review, every dollar you earned is taxed at a different rate that gets progressively higher the more you earn. However, it only affects your next dollar earned. It doesn't go backwards. So never turn down income. You can defer it, and that's part of tax planning, but don't turn it down. If you do that, you're throwing money away. Thanks for watching. Hopefully this was helpful. If you need any assistance, please reach out to us here at Capital Gains Advisory.